The pandemic has really changed things up for a lot of people, right? It could be from their income. It could be from, let's say, they had rental properties and all of a sudden people are not paying the rent. So now they're carrying those properties as well. Let's talk about refinancing your home, because some people, the beauty of having your own property is not only are you able to pay your own mortgage and eventually own, but you are able to pull out that equity, right? That's what everyone is selling, the dream of being a homeowner. So this is a scenario, I would think, a time when people would be like, hey, I've had this home and the equity that I've built in it should be able to help me out in these dark times, right? So when you have a client coming to you, can you walk us through that? Should people be considering refinancing their home right now? And in what scenario should they be doing that?
Refinancing is a good way to rebalance your debts. So if you go, you know what, Ray, I've got a property that's worth $1 million. For the last little while, either because you got sick or extraordinary expenses or anything of that sort, let's say your mortgage amount is 500,000. You accumulated maybe a car loan, you accumulated unsecured debts like credit cards or unsecured line of credit or loan. Those ones are typically higher interest and higher monthly payment or biweekly payment, however you have it set up. Now, if you use refinance or your home as a security with a mortgage, you actually get a lower rate because our rate right now are really, really good. And we can also expand the payment schedule up to 30 years, right? So that's where you go. You win in terms of the interest rate is lower, and you also win because you get to set a lower minimum payment. Now, setting the lower minimum payment doesn't mean that you can't pay it sooner, but it does give you more control on what's affordable today. And then maybe a month from now or 2 months from now, there's another interruption in income. You go or your expenses go and bring it back down. So it is a good tool, refinance, to rebalance your debt. Now you can use it for a lot of other things, such as you mentioned earlier. Hey, I've seen properties increase in value, and maybe you're a believer that prices of homes in the long term may not be in the short term, but in the long term increases in value. So if that's something that you believe in, you would go, okay, I'm in. It's probably a good idea. We can leverage your current equity in your home, and then you can reinvest that into other properties. And then there's also a scenario where, if you have a lot of debts, but at the same time, you also don't have the just in case funds. Guess what? It's usually not a good idea to look at debt when there's extraordinary expenses, but this is a scenario where you go, well, we're still in the middle of a pandemic. You don't know what's going to happen. Maybe if you're going to go through rebalancing your credits, maybe we also want to take a little bit more for just in case funds. Now it opens up your scope to maybe start investing in stocks and mutual funds. And maybe again, it gives you a little bit of a head start to start saving more. So if we're able to lower your payment and you start a little bit of investment savings, the lower payment, you can start, and saying there's more affordability there, have more disposable income, they have more money to use, you can start saving, right? So again, when it comes down to it, the refinance is good when you have the components that the lenders use to approve. Now, unfortunately, sometimes, you may have $500,000 worth of equity in the home because your property is worth $1 million. You have a mortgage of 500. If you've lost your job or you got sick, your income is not there. You've seen, that your credit history went down because you had to use all this debts. Those are the worst times to look at borrowing. So when you have the income and you necessarily don't need it currently, you may want to put in the scenarios that you need just in case. So if you're desperate for the money because certain things have already happened because of your income, your credit history, those are the scenarios where you could say, hey, I need help. For those scenarios, unfortunately, you're going to be considered as a higher risk. Not that we can't find lenders for you, it's just that maybe that's when we move down to the B lenders and stuff.
That's so interesting you say that, because that's usually the times when people need the money. So that's when they're going to be considering refinancing. I can't imagine anyone's like, I've got lots of money coming in, but I'm going to refinance my mortgage.
I know. That's the irony of household finances, right? So when you think everything is going well, that's the perfect time to plan out what you're going to do, whether or not, adding some insurance, some, just in case funds that we mentioned, planning for your current debt, what we're going to do, because you're employed, you've got everything is nice and nice and good, and you're complete control, and all the lenders love you right now. With the moment that you yeah, when you lose your job and you've already accumulated so much debt that it affected your credit history, even though you have you have a equity on your home, sometimes those are the times that are a little bit more difficult to finance.